Hey everyone, welcome back. As promised, I said that as soon as the new tax bill is introduced, I'm going to do an updated video on it. And finally, Congress passed, or not passed, but they introduced the draft version of the one big beautiful bill that is now going through Congress and potentially may pass. But in today's video, I'm going to go over each of the new provisions that are potentially going to go into law. Now, some of these are things that I've already talked about in a previous video, and some of these are new. And in fact, some things that I talked in the previous video are just not in this video at all. They're not in the final bill. So for example, the Social Security income exclusion that was talked about a lot during the campaign trail and also discussed a lot before the bill was passed is nowhere to be found in this final version. So hopefully when they do pass something, it's going to include something about Social Security income exclusion, but for right now, it's not in there. So without further ado, let's jump into what the new provisions are going to be and what they're going to look like. So the first thing that is in the bill is the individual income tax rate. So those have been made permanent. So the Tax Cuts and Jobs Act changes to the income tax brackets have been made permanent. And not only that, they have been indexed for inflation. So that's a huge benefit for individuals as their income grows, that also they're not crept into a larger tax bracket like it's happened in the past. So in the current bill, not only are the tax brackets permanent, but they have also been indexed for inflation. Also, a new addition is there's a standard deduction boost. So if you're a single filer, it's an additional $1,500. If you are head of household, it's an additional $1,000. And there's no mention of people who are married filing jointly, but the assumption is that if you're married filing jointly, it's just going to be double of whatever the single is. So it's going to be about $3,000. Also, if you're a senior 65 or older, there's also an additional $4,000 boost on the standard deduction, but there is an income eligibility threshold. So if your AGI is over 150 and you're over 65, you're not going to get that $4,000 additional boost. But if you're over 65 and your income is below the 150, then you'll be eligible for the $4,000 additional income boost. The new bill also expands the child tax credit, so it increased it to $2,500 per child, and that's from 2025 to 2028. And there's also inflation adjustments, but after 2028, or actually starting in 2029, it reverts back to the current $2,000. So there is a bump up of $500 for the next 3 years, but then it reverts back to the original $2,000 that it is now. And also there's a new requirement that to claim the child tax credit, the child must have a Social Security number as well as a spouse and the parent. A new thing that was not discussed anywhere in the campaign trail and was not discussed anywhere else that was entirely new is this thing called a MAGA account, which is a money account for growth and advancement. And this is a new investment account for children under the age of 8. And it's a $5,000 annual contribution limit that's also indexed for inflation. And it has many different types of investment options, including U.S. index funds. And you can open this up with your traditional custodian account, such as Schwab or Fidelity. And for each eligible child that's born from 2025 to 2028, there's a benefit that the government gives of $1,000 of a federal deposit. And right now there's no income limitation for that. So regardless of what your income is, if you qualify and have a child between 2025 and 2028, you're eligible for that $1,000 bonus contribution into this MAGA account. I think a huge provision of this new bill is the increase of the QBI deduction. And if you're not familiar with the QBI deduction, look at another video I did, actually several videos I've done about what the QBI is and how to calculate it. But the new bill increases the QBI from 20% to 23%. And it also phases out some of the limitations for service-based businesses such as CPA firms, law firms, architectural firms that were previously prohibited from doing the QBI deduction if their income was too high. This new bill bumps up that limitation considerably, and it makes it much easier for these these types of companies to qualify. Another huge item that's in the new bill is the the estate and gift tax exemption has been increased. So the exemption has now gone up to $15 million, and it's permanent and it's also inflation adjusted. Had this not been included in this final bill, it would have reverted back to the pre-Tax Cuts and Jobs Act of 2016 to $6 million. So it's a massive increase in the estate tax exemption for a lot of people. Another big boost of this bill is that AMT income thresholds have been made permanent. So before the Tax Cuts and Jobs Act, the AMT thresholds were very, very low, which meant that just normal everyday people were getting caught up in paying the regular tax plus the alternative minimum tax. But because of the Tax Cuts and Jobs Act, that increased that threshold considerably. So now only significantly higher income individuals, higher income people were paying the AMT, which is what the intended purpose was Another thing the new bill does is it expands the Section 179 expensing for businesses. That means that businesses now can buy equipment, are able to immediately expense it. So that way it encourages businesses to expand and do more capital expenditures. Another part of the bill that's going to be impactful for individuals is the new 1099 rules for 1099Ks and 1099 NECs. So on 1099Ks, essentially you're not going to get a 1099K unless you get at least $20,000 of income and 200 transactions. If you're not familiar with what 1099s are, either 1099K or 1099 NEC, look at another video I did where I talk extensively about the differences between the two 1099s. But on the 1099 NEC and the 1099 miscellaneous, the current threshold is $600. So if someone pays you $600, they have to issue you a 1099. The new bill bumps that up to $2,000 starting in 2025, and it also indexes it for inflation. So the threshold is significantly higher than what it was before for issuing someone a 1099, and that's good news for the individual receiving a 1099, but also the businesses that have to issue the 1099s because it's costly for them to do so. Another highly anticipated portion of the bill is the tip income deduction, also known as no tax on tips. Now, obviously, during the campaign trail, it was just made very simple, no tax on tip, but the final bill gives a little more detail and a lot more limitations. For example, in the new bill, it allows individuals to deduct up to $10,000 of reportable tips. They have to be reported on your W-2. It only applies to certain professions, so people who are customarily receiving tips, such as restaurant servers, bartenders, barbers, nail salon individuals, people who are in the industry of typically receiving tips. And it also has an income threshold. So if your income is above 150, you're not eligible for this $10,000 deduction that you would get on tips otherwise. And a lot of people ask, why would you have this limitation? Well, it's because it prevents people from trying to circumvent the law. So for example, an employer could essentially give someone a very low base and then say the difference is all reported tips, essentially giving them a massive tax deduction. So the limitations are preventing employers and individuals from trying to circumvent the rule and getting much larger tax deduction, when the intent is for people who are regularly getting tips, such as servers or bartenders, from being able to benefit by not having to pay tax on those tips. Another highly anticipated part of the bill was the overtime pay deduction, touted during the campaign trail as no tax on overtime pay. Well, under this new provision for overtime pay, it's just like the no tax on tips, where there's going to be limitations. Essentially, the overtime pay has to be reported on your W-2. There are income limitations, so if you make over $150,000 a year, you're not eligible for it. And the overtime pay has to be separately stated on the W-2. Now, the reason why they're doing these restrictions is, again, to avoid people from taking advantage of the system, whereas someone could give a very low base salary, and then the difference could be considered overtime pay, quote, overtime pay, and then trying to avoid having to pay tax on it. So they're trying to avoid people from doing that, and they're doing this by creating limitations on the overtime pay deduction. The bill also includes a deduction on interest paid on car loans. The interest has to be over $600 a year, but it excludes luxury vehicles and also business vehicles that are used for business. There's also a change in charitable contributions for people who don't itemize. So people who do not itemize, And if you're not familiar with itemization, look at another video I did where I go over the difference between itemization and the standard deduction. So someone who takes the standard deduction, does not itemize, is now eligible to take up to a $300 deduction for charitable contributions if they're married, or $150 as an individual. Whereas under current law, if you don't itemize and you make charitable deductions, you're not able to deduct it on your tax return. A couple of things that didn't make it into the final bill are the elimination of the SALT deduction. The SALT deduction is the state and local income taxes that individuals pay. So people who live in California or New York that pay a lot in property taxes, before the Tax Cuts and Jobs Act, there was no limit on how much they can deduct of those property taxes. Because of the Tax Cuts and Jobs Act, they capped that at $10,000 a year. There was a lot of talk on whether that was either going to be doubled or completely eliminated. I mentioned it in a prior video, but unfortunately that did not make it in the final bill. So the current $10,000 limitation still stands. Another item that was talked about extensively during the campaign trail and also in a prior video I did that a lot of people expected was going to be in the final bill is the Social Security income exclusion. So a lot of people assumed in the final bill there was going to be something that excluded Social Security income, but unfortunately that was not included in the final bill. Now obviously this bill has not been signed and it has not been finalized, so there is a small possibility it could be in there, but it doesn't look like it'll eventually be in that final bill. Also not in the final bill is a mortgage interest deduction. So before the Tax Cuts and Jobs Act, there was a mortgage interest deduction was on $1 million of mortgage debt. That got reduced to $750,000 of mortgage debt based on when you bought your home. There was a lot of talk on whether that was going to revert back to the $1 million or completely eliminated. Unfortunately, that too did not get into the final bill. So the $750,000 limitation still applies according to the current bill.